We are watching two entirely different economies operate at the exact same time. Institutional wealth is accelerating, while the foundation supporting average consumers is crumbling. This scorecard shows the top end of the divide. Markets are sitting near record highs, driven by an estimated $800 billion in artificial intelligence infrastructure spending this year alone. Tech companies are pouring their capital into data centers and advanced chips at a scale that dwarfs historical technology investments. Now look at the right side of this same board. Credit card delinquencies have climbed to 13%, and inflation continues to outpace median wage growth. Your daily expenses are draining your liquidity faster than your salary can replenish it. At the exact same time, autonomous AI agents are moving past simple chat functions and taking over complex analytical tasks. Roles in coding, accounting, and digital marketing that used to guarantee a safe middle-class income are being executed by algorithms for pennies. Institutional wealth is facing its own structural crisis. Between 7 and 12% of commercial real estate mortgages are defaulting. Empty office buildings and maturing loans are actively breaking the balance sheets of regional banks. Traditional advice, saving a little from your paycheck and climbing a standard corporate ladder, is failing against these metrics. You have to make a choice between prioritizing immediate cash to survive inflation or building asymmetric leverage. The record-breaking numbers at the top often mask the fragility at the bottom. To navigate this, you can't just follow the headlines. You have to match your chosen strategy to the actual hours and capital you have available. Path A is for the cash-strapped earner. If inflation and high-interest debt are draining your bank account, you need immediate liquidity. You cannot wait months for a return. Your vehicle here is the active hustle. This involves providing direct, high-value services like virtual assistants, B2B freelance writing, or digital decluttering coaching for disorganized businesses. The input requirement is physical. You take skills you already have and leverage them for 10 to 20 hours a week, directly servicing clients. The outcome is fast, predictable cash flow. Depending on your niche, these services pay between $25 and $150 an hour, and the money hits your bank account almost immediately upon project completion. The trade-off is a hard mathematical ceiling. Because you are trading physical hours for dollars, your income stops the second you stop typing. You also face a hitting operational cost. As an active freelancer, you owe a 15.3% self-employment tax. Your employer no longer pays half, meaning you must maintain bookkeeping to account for quarterly payments. Active hustles are an excellent, necessary short-term survival mechanism to clear toxic debt, but they will never decouple your time from your earning potential. Path B is for the white-collar optimizer. You have a stable paycheck covering your baseline expenses, but you recognize that AI is coming for your industry, and you need a way out. Your vehicle is passive digital assets. Instead of servicing clients, you build niche software tools, video courses, or specialized business dashboards in platforms like Notion or Airtable. The input is intense. You will sink 40 to 100 hours of highly focused, uncompensated time into building a specialized digital product. This graph plots the trajectory of digital assets. Once the product crosses that threshold, you own a sovereign asset with zero marginal cost of replication. A successful portfolio can scale to $10,000 a month in recurring revenue, with minimal ongoing maintenance. The primary trade-off is enduring the valley of disappointment. You have to accept a high risk of total failure, knowing you might spend 3 months building something the market rejects completely. You also carry external platform risk. Selling on marketplaces like Gumroad, Udemy, or Etsy means your distribution is tied to algorithms you do not control. Establishing digital assets that require no additional cost to replicate provides a buffer against the widespread automation of white-collar tasks. It takes time, but it builds an asset you own. Path C is for the capital deployer. You have cash on hand, but you recognize that paying top dollar for tech stocks in the middle of an $800 billion spending frenzy is a massive risk. Your targets are physical distress and passive yields, specifically distressed commercial real estate or conservative dividend ETFs. Right now, commercial mortgage-backed securities are failing. Operators took out 3 to 5 year adjustable rate loans when money was cheap. Those loans are maturing, and operators cannot afford the higher interest rates, causing defaults to spike. For a prepared investor, this forces a reset. Banks are taking properties back, creating opportunities to acquire distressed multifamily units at steep discounts, sometimes 40 cents on the dollar. The trade-off is severe. Distressed real estate is a deep liquidity trap. Rents are flat, operational expenses are up, and you take on high vacancy risks and the burden of complex operations. If managing physical distress is too operational, the alternative is routing that capital into broad dividend ETFs or real estate investment trusts, locking in safe, passive yields of 4 to 8%. Deploying capital successfully in 2026 means hunting for systemic distress rather than chasing tech momentum. You accept a lack of liquidity in exchange for acquiring generational value at a discount. Because these three paths have conflicting demands on your time and money, choosing the wrong one for your current situation is a recipe for stagnation. This quadrant chart pluses out exactly how they differ. Active hustles cost time but carry zero financial risk. Distressed real estate requires heavy capital and carries high risk. Digital assets sit in the middle, requiring massive time with moderate risk. If you are drowning in 13% credit card debt, spending 6 uncompensated months building an online course will ruin you. If you have capital but no time, launching a freelance writing business makes no sense. But generating the income is only the first step. You have to shield it. The IRS introduced new standard deductions for the 2026 filing season. Taxpayers are now eligible to deduct up to $25,000 for qualified tips. Additionally, individual earners can deduct up to $12,500 for qualified overtime. For joint filers, that overtime deduction doubles to $25,000. To utilize these tax shields, you must treat your side income as a formal business entity. You need separate accounts and rigorous administrative discipline. Officially incorporating as an LLC is required to unlock these business tax benefits, while legally separating and protecting your personal assets from liability. Generating wealth in 2026 isn't about finding a secret internet trick. It requires auditing your exact constraints, your debt, your time, your cash, and ruthlessly committing to the single vehicle that fits your reality. Choose your hard.